Thank you so much, Anthony. We've got ourselves an interview coming up with a live guest. Joining us now is Mr. John Kingston. He is our editor-at-large at FreightWaves. John, welcome to the show.
Well, I'm very happy to be on as a live guest. I don't think a dead guest would have actually helped in the ratings, but anyway, so glad to be here.
We like to keep it fresh and we like to keep it live, sir. No pre-canned stuff on this segment.
That's good.
Wanted to dive right in.
So
Yes, sir.
Yeah. Let's give some numbers to get started, okay? After all of the craziness of the past few, last week and the week before and everything leading up to the Russian invasion of Ukraine, the price of ultra-low sulfur diesel on the CME commodity exchange settled Friday at a number that was all of 1 cent higher than where it settled February 3rd. So there's a lot of volatility. It had moved up and down, but after Friday would have been like the third or fourth day of the invasion. The price of ultra low sulfur diesel ULSD had effectively not moved from where it was February 3rd. Now, that is not the case today. The case today is that the price on CME is up about 14 cents. Today is the day that the EIA will release its weekly diesel price. That is the price that is used for setting surcharges. The DTS.USA data stream in Sonar is up about 6 cents since last Monday. So, keep that in mind if you're looking toward what the EIA might do later today. So what's really happened today is there's really no change in the supply-demand situation in oil, except for the fact that there are a lot of reports that even though there are not specific sanctions against Russian oil exports, a lot of companies just do not want to deal with them. There's just too much uncertainty. There's too much insurance risk. So even though the exports aren't being sanctioned per se, what's happening is that companies are just staying away. Now, at a certain point, what will happen is that will make the price of Russian material significantly cheaper than everything else, and some companies might step in to take advantage of that spread. But right now, there are effectively sort of what I would call private sector sanctions against Russian oil exports, and that's tightening up the market.
So, John, when you look at the situation and the pricing pressures in the market, of course, this hasn't quite happened before, but are there any scenarios that you look at towards the past where, like, okay, this is something kind of similar that we can expect to happen over the next week or so?
Well, of course, the main thing that I would go back to would be the 1990 invasion of Iraq by Kuwait. And at that point, the whole world banned import purchases of both Iraqi oil and Kuwaiti oil, because at that point, the Kuwaiti oil, of course, was controlled by the Iraqis. Now, what was great then was that Saudi Arabia had a lot of spare capacity on the market, a lot of spare capacity at their fingertips that they were able to bring onto the market. You don't have that kind of spare capacity now to fill in for any significant loss of Russian supply, so that's a problem. Now, there are two things that might happen here. I think one of the ones that's most significant is that there have been talks going on in Vienna to ease the sanctions on Iran. And those sanctions have kept anywhere of 1 million to 1.5 million barrels a day of Iranian oil off of the market. Now, let's remember, Russian oil exports are like in the 7 million barrel a day level. So, you can see the difference. So we may get some of that Iranian oil back. There's also talk that there will be a working in consort. All the nations of the world, really, all the nations of the International Energy Agency will release a significant number of strategic stocks onto the world market. But I think, the number there was 70 million barrels. That's not really a lot. That's not even 1 day's worth of world oil consumption, but it is a significant shift of oil into inventories. I think, quite frankly, and this is rather discouraging, I know from the perspective of a diesel consumer, Goldman Sachs said in a report this morning or overnight that the only thing that it thinks is going to have any significant impact on demand or a significant flattening of the price rise is demand destruction. When individuals or companies or whoever decide to use less oil because the price is so high. And they felt that the price of oil, which Brent hit $100 this morning again. Actually, I think it was as high as 104. You really needed to get up to about 120 to start to see that significant demand destruction. So their argument was that even with all these other steps that might get taken, the end of Iranian sanctions, maybe some release of strategic stocks by the Western oil-consuming nations, there wasn't a lot to really stop the price of oil from rising another $10 or $20.
I think you really bring up a great point in terms of not only the price of oil, but the impact on demand. I'd read a report a week prior, before the invasion, that stated if oil went up to $115 per barrel, the potential estimate of inflationary pressures could be upwards of 10%, just because, like you said, it gets passed down throughout the supply chain, ultimately to the consumer. If we reach up to 115 to 120%, do you think there's going to be this crazy jump in the diesel market? How is this going to impact our domestic environment if it gets to that level?
Well, diesel has been running a little stronger than crude in the sense that the spread against crude has been it's been strengthening. So it's over time it's been rising faster than the price of crude. Certainly with Russia as a major diesel exporter, I think it could assume that would continue to happen. But at a certain point, the economics end of making diesel get so good that people will make more of it, and the price will kind of normalize back down to crude. I will say that one thing that's kind of been a little bit of a mystery is that world refining capacity, not world refining capacity, but world refining activity has not really been at the levels you would expect it to be. Now, obviously, if they ramp up, they need more crude to do it. But I think that's one of the reasons why inventories are so tight, is that refineries have been running on a somewhat restricted level for reasons that nobody fully understands. Now, it's particularly discouraging to see that now, because tomorrow is March 1st. March and April, February and March, and maybe some of April are what's known as maintenance season. When refineries have big projects they need to do to maintain some of their units, what they do is they usually tend to close them down, maybe not the whole refinery, but that unit, in like February or March, or let's say September, October into November, because that's before the big rush seasons. If they do it in February and March, that's getting ready for the gasoline season in the summer. If they do it in September and October, that's getting ready for the heating oil season. So you probably aren't going to get a big jump in refinery activity over the next month, and that's a little concerning. Let me get back to your other point, though, about the price. If you take remember the all-time high price was about $140 crude. That was in July 2008. We had $100 oil, $100 Brent pretty consistently in 2011, 2012, 2013. The world economy did okay then. I mean, this was not quite, it certainly was a non-inflationary economy, and it did not really crush economic activity. So if you take that price, let's say $100 from 2011, 2012, adjusted for inflation, and you're up to about, let's say, maybe 115, 120. I'm guessing at that, so I could be wrong there. You're back to where you were in 2011, 2012, and things weren't that bad then. Let me also note that in terms of trucks, virtually all new trucks on the road are certainly more fuel efficient than they were even 10 years ago. So that allows you to kind of get through this in a little better position than maybe you were back in 2011, 2012.
And John, bringing it back to your previous point of potential sanctions being lifted on Iran, a little bit of a geopolitical question, shot in the dark here, but do you know if there's any type of relationships or alliances between Iran and Russia, and if this movement on potentially taking more Iranian oil into the market kind of rubs anyone the wrong way, or is this just two completely different entities and parties here?
That's a really good question. I would say I'm not certainly an expert on Iranian sanctions, Iranian ties with Russia, but I will say that, as we know, both Iran and Russia are very tied at the hip through Syria, and Syria has been very vocal in supporting what the Russians are doing in Ukraine. So I can imagine a kind of a Russia-Damascus-Tehran tie on all of this. But I'm a little bit out of my depth there. But I mean, it's a good point. Are the Iranians going to rush to flood the market if that's going to help the Western powers that they've always opposed, and maybe hurt the Russians, who are at least allies to the issue of Syria?
One more question here. I'm thinking, so we're talking about the angle as well with potentially Iran and Russia trying to fill this gap, since we are losing quite a bit. Is there any way for, domestically the United States to help step in, or is this going to be a situation where we're kind of in uncharted territories, taking out, 7 million barrels from the market, and then with prices being as they are? What are your predictions in the coming few weeks?
Well, let's get settled here. A couple of things here, okay? Despite a lot of social media chatter, the United States produces more today than it did on the day that Joe Biden took office. There is a view running out there that Joe Biden has killed the U.S. industry and that production has fallen. That is not true. On the day that Donald Trump left office, the U.S. was producing about 10.9 million barrels a day. Today, it is producing about 11.6 million barrels a day. Now, the thing it's a good question, Thomas, but the factor that's here that has nothing to do with the presidents is that the shale industry is not going to repeat what it did in 2018 and 2019. What did it do back then? It drilled like crazy. It borrowed lots of money. It drilled lots of wells. It produced a lot of natural gas. It produced a lot of oil. It had no free cash flow. It paid no dividends. And then they would go out and borrow more money, and they would do the same thing all over again. That is a model that is dead and buried. The industry has made very clear that it is going to run itself. I mean, individual companies said this, that they are going to run themselves like a normal company. They're going to seek to generate free cash flow. They will seek to pay dividends. They will not be just some debt-fueled, maniacal group of operators seeing how much they can get out of the ground. So, the rig count is good. The activity is starting to come back to a certain degree, despite what I just said. I certainly think that there can be some increases in U.S. production, but you're not even going to tack on 1 million barrels a day in the U.S. You might tack on another several 100,000 barrels a day, so the U.S. can have its part. There is no, quite frankly, government restriction right now on any production. I personally, as a New Yorker, I would like to see New York get rid of its ridiculous fracking ban and produce lots of natural gas and ship it to New England so we don't have to take LNG into New England. Instead, we can ship it to Europe to displace Russian gas. That's what I would like to see. But I don't know that that's going to happen. Maybe not until after the election. So anyway, I don't know if that answers your question, but I think that the question was, how much can the U.S. do? And I think it can do something, but it's not going to add 1 million or 2 million barrels a day, getting back to where it was at its all-time peak, which I guess was 2018, 2019.
John, I'm with you on those changes in New York as well. Thank you so much for this update. This has been incredibly timely and, of course, insightful. We'll be sure to check in with you, of course, throughout the week as the situation continues to develop.
Thank you, guys.